You open an investing app for the first time. You are ready. You are motivated. And then you see it. Stocks, ETFs, index funds, and suddenly you have no idea what you are even looking at. Which one do you pick? What is the difference? Does it even matter? It does matter. And by the end of this video, you are going to know exactly what each one is and which one makes the most sense for where you are right now. Welcome back to Cents and Commas. These are the three most common things beginners buy when they first start investing. And while they are related, they are not the same thing. Think of them like three different ways to participate in the market, each with its own personality. Let us meet them one by one. A stock is a share of ownership in one specific company. When you buy a stock, you are betting on that one company. If it grows, your investment grows. If it struggles, so does your money. The upside of individual stocks is that the potential gains can be significant. If you had bought Amazon stock early on, you would have made a life-changing return. The downside is risk. When your money is tied to one company, everything depends on how that one company performs. Leadership changes, bad earnings reports, a scandal, a competitor, any of it can tank the price. And if that company goes under, you could lose everything you put in. Stocks require you to do your research. You need to understand the company, follow the news around it, and have some conviction about why you are buying it. That is a real-time investment on top of the financial one. An index fund is a collection of stocks bundled together that automatically mirrors a market index, like the S&P 500. An index is just a list of companies tracked together. The S&P 500 tracks 500 of the largest companies in the United States. When you buy an S&P 500 index fund, you are not picking one company. You are buying a tiny piece of all 500 at once. Apple, Microsoft, Google, JP Morgan, Nike, all of it in one purchase. Because index funds are not actively managed, meaning no fund manager is sitting there making daily decisions about what to buy and sell, they have very low fees. That matters more than most people realize. Even a 1% difference in annual fees can cost you tens of thousands of dollars over a 30-year investing period. Index funds also have a track record that is hard to argue with. The S&P 500 has historically averaged around 10% annual returns over the long term. Most professional fund managers do not beat that consistently, and you can own it without picking a single stock. The trade-off is that index mutual funds are not traded like stocks throughout the day. You buy or sell them at the end of the trading day at that day's closing price. For a long-term investor, that rarely matters, but it is worth knowing. An ETF, exchange-traded fund, is similar to an index fund in that it holds a collection of investments. But unlike an index mutual fund, an ETF trades on the stock market throughout the day, just like an individual stock. You can buy it at 10 a.m. and sell it at 2 p.m. if you want to. Most ETFs also track an index, so in terms of what is inside them, they look a lot like index mutual funds. The S&P 500 has both index funds and ETFs that track it. The difference is mostly in how they are traded. ETFs also tend to have very low fees, some as low as 0.03% annually. That is nearly nothing. One more difference worth noting. Most ETFs do not have investment minimums. You can buy a single share of an ETF, sometimes for under $100. Some index funds at certain brokerages do have minimum investments to get started. For most beginners, the practical differences between index funds and ETFs are small. The bigger distinction is really between both of those and individual stocks. Let me put these side by side so you can see it clearly. A stock is one company. You can gain or lose a lot. You need to research and monitor it. The risk is high, but so is the potential reward. Fees are low because you are just buying shares. Best for people who want to actively follow and choose companies. An index fund is a collection of companies that mirrors an index. Risk is spread out across many companies. Low fees. Historically strong long-term returns. Trades once per day at end of market close. Best for hands-off long-term investors. An ETF is also a collection of companies, usually tracking an index. Low fees. Trades throughout the day like a stock. Very accessible with no high minimums. Best for beginners who want the diversification of an index fund, but the flexibility of trading like a stock. The thing all three have in common: You can get started with any of them through any of the major brokerage platforms we talked about last episode. So which one should you start with? Here is the honest answer. Most financial experts, and I mean the ones who study this for a living, recommend that beginners start with index funds or ETFs rather than picking individual stocks. Not because stocks are bad, but because diversification protects you while you are still learning. When you are new, you do not yet have the experience to evaluate whether a company is actually a good investment or whether you just like their product. Buying a single stock based on vibes, even good vibes, is a real risk. Index funds and ETFs give you exposure to the market without putting everything on one company's performance. Think of it this way. Picking individual stocks is like betting on one player to win the championship. Buying an index fund is like owning a piece of the whole league. One player can get injured, the league keeps playing. Now, does that mean never buy individual stocks? No. A lot of investors do both. They build a stable foundation with index funds or ETFs, maybe 80 or 90% of their portfolio, and then use a smaller portion to invest in individual companies they believe in. That balance gives you stability and the chance for higher returns. But if you are brand new and you are not sure where to start with a broad market ETF or index fund. Get comfortable. Let your money grow. Then expand from there. Stocks give you ownership in one company. High risk, high potential reward. Index funds give you a basket of companies mirroring a market index. Lower risk, low fees, strong long-term track record. ETFs do a lot of the same thing but trade throughout the day like a stock and tend to have no high minimums. All three have a place in investing. Most beginners should start with ETFs or index funds and build from there. Subscribe and drop a comment telling me which one you are leaning toward. Stock, ETF, or index fund. I read every single one. See you in the next episode.